Hi everyone, hope you all are doing well. This video is about investment appraisal. We are not going to discuss the theory here. We are going to do a ACCA case. From that case study, we are going to learn the theory. To do a investment appraisal case study question, we need to follow 6 steps. First one is initial findings. Second one, identify relevant cash flows. Third one, inflation. Fourth one, taxation. Fifth one, net present value table. And sixth one, recommendation. Okay guys, we'll go straight into the case. This is the case taken from ACCA revision kit. I am not going to read the case and waste the time. First, pause the video, take 3 minutes, read the case. Fine. Hope you all have read the case. We'll analyze the case step by step. Always remember, in investment appraisal cases as requirements, they will ask you to compare or appraise 2 separate products or projects, or else ask you to appraise the current product or project if management made an incremental investment. In the end, we should advise the management whether the investment is profit making or loss making. Here guys, in requirement A, examiner is expecting you to calculate net present value of the gymnasium and spa project. In requirement B, examiner is asking you to give recommendations about this project, whether you are accepting or rejecting this project. Okay, we are moving into action now. Step 1, initial findings. Currently, this hotel is operating and it has a library for their guests. Now, management has planned to convert this library area into gymnasium and spa. So, the case is an incremental case. They have to buy equipments and refurbishment. Spa cost, refurbishment cost will be 100,000 and equipment cost for gym will cost around 50,000. Life of this project is 4 years. Moreover, there will be $15,000 of scrap value in the end of 4th year. Feasibility report cost is 10,000, which is not relevant for this appraisal because this cost will be incurred anyway. In other words, this is a sink cost. Alright guys, now we are moving into step 2, which is identify relevant cash flows. Here, cash inflows will be there, cash outflows will be there. The difference between cash inflows and cash outflows will be incremental net relevant cash inflow. Fine. First of all, cash inflows, in that if the operations of the hotel is continue as usual, what is the revenue? Revenue is going to be 40 rooms will be there, 80% occupancy will be there in the hotel, and $250 per room, and 360 days the hotel is going to operate. So revenue is going to be 2,880,000. Now, what if hotel implement the spa and gym in the operations? The rooms will be remain 40, no issues. The occupancy level will increase to 82%, and the room rates will be increased to $262.5, and operations will continue 360 days. So in this point the revenue will be 3,099,000. So annual incremental revenue will be you have to deduct 3,099,000 from 2,880,000. So the incremental revenue will be 2,19,600. Here To find the actual cash flow, we have to deduct all relevant costs, cash outflows or expenses. Management needs 4 new employees at 30,000 annual salary. So the annual staff salary will be 120,000. In the overhead note, first point is about area wise cost. This cost is not relevant to this case because though they implement this investment or not, they are incurring this cost due to library. But second note is relevant. According to that, their expense will increase by $42,000. Finally, cash flow will be 57,600 per annum. How this 57,600 per annum came? We have to deduct all the cash outflows from our total revenue received, which is 200. We have to deduct 162,000 from 219,600. Step 3, finding inflation. According to inflation note, 4% will be applied to revenue, overhead costs and staff cost. This means inflation will be applied on revenue generated through the year, which is 57,600. Guys, when you are calculating inflation, try to do that calculation through this chart method. Charts should include year column, cash flow column, inflation column and inflationary cash flow column. Here, according to the question, for the year 1, there won't be any inflation. So year 1 cash flow will be 57,600 and there will be no inflation. So inflationary cash flow at the year end will be 57,600, same amount. By going through this chart, we can understand how inflation has applied to each year's cash flow. The end value of the previous year will be set as current year's cash flow. From the end values, we can understand that we have to get here is we are having 57,600 cash flow each year, but because of inflation, this amount is changing each year. For example, first year's year-end inflationary cash flow is $57,600. This $57,600 will be set as second year's cash flow. And now from second year onwards, there will be 4% inflation. So for 57,600, we have to apply 4% inflation. This will result as $2,304. So we are going to add now second year's starting cash flow, which is $57,600, and inflation amount of the second year, which is $2,304. Together, it will result as inflationary cash flow of $59,904. And this $59,904 will be set as third year's cash flow. The calculation will be carried out like this. Now it's step 4, taxation. Before that, guys, remember, I choose this question because this question includes all 6 steps in one question. Therefore, I choose this question so I can explain all these 6 steps in one shot. With that note, we'll continue finding taxation. According to the question in note 1, depreciation is available in the question. So step by step we'll do this taxation. So we are moving into depreciation chart. So depreciation chart is showing how to calculate depreciation for refurbishment, installation and equipment cost, which is $150,000. Here we should understand something very clearly. In the end, scrap value must be $15,000. Therefore, I have added $15,000 in the end value cell and found the depreciation amount. So year 1, the value will be 150,000. We have to calculate depreciation in reducing balance method. They have given that in our question. So 150,000 into 25%, depreciation will be 37,500. So we are deducting 37,500 from 150,000. The end value will be 112,500. This 112,500 will be set as second year's brought forward value. So for that amount, we are again calculating 25% depreciation. That will result as 28,125. We are deducting 28,125 from 112,500. The end value for the year 2 will be 84,375. The calculation will be continue as like that. So 84,375 will be set as third year's brought forward value. For this amount, we will be applying depreciation 25%. That will result $21,094 as depreciation. So we are deducting 21,094 from 84,375. That will result as the third year's end value, which is 83,281. This will set as fourth year's brought forward value. For that, we can't apply 25% depreciation, because if we apply that 25% depreciation for 63,281, this will result as a wrong amount. So what we have to do is, we have already added $15,000 in the end value column for the fourth year. So this is given in the question itself. So how we can calculate our depreciation for the fourth year is, we have to deduct $15,000 from fourth year's brought forward value, which is 63,281. This will result as the depreciation for the fourth year, which is 48,281. It's time to calculate the taxation. What we are going to do is, we are going to calculate the taxation through this chart method. This chart will be consist of year column, cash flow column, tax depreciation column. This tax depreciation amounts will be carried forward from the depreciation chart. Then we will have a tax profit column and tax column. Then there will be two additional columns, which are half of tax and tax payable columns. I will explain why I have added two additional columns, which are half of tax and tax payables, in a while. In the process of tax calculation, as cash flow, we are going to take the inflationary cash flow, which we have calculated in the step 3. So here, for the year 1, I have taken 57,600 as cash flow. From that 57,600, we are going to deduct 37,500, which is the tax depreciation we have found. Then the result will be taxable profit. which is 20,100. For this 20,100, we are going to apply 30% of tax, which will result 6,030. This particular 6,000. Now it's time to explain why I have added 2 additional columns for the chart. This 6,030 is our 30% of taxable profit. But question is little tricky at this point because they have mentioned that half of the tax payable is the current year. Therefore, I have added an additional column, half of tax. That column will consist of half of the 30% tax, which will be $3,015. In other words, 6,030's half is $3,015. And the other half of $3,015 will be paid in the second year, with second year's first half of 30% tax, which means first year they pay half of tax payable for the year, and second year they pay first year's balance tax and half of second year's tax payable. Only to meet that condition, I have made this table with 2 additional columns. For the year 2, our inflationary cash flow will be $59,904. From that, we are deducting $28,125, which is our depreciation amount. The result will be our taxable profit, that will be $31,779. We are applying 30% taxation for that $31,779, which will result as $9,533. So according to the question, we are going to pay half of this $9,533 in this current year with previous year's half, which is $3,015. So total tax payable for the second year will be $7,781.5. So this process will be carried out like that. Third year, inflationary cash flow will be 62,300. From that, we are deducting depreciation amount of $21,094. The taxable profit will be 41,206. For that, we are applying 30% taxation. That will result $12,362. Half of that $12,362 will be paid in third year, and previous year's half, which is $4,766.5, altogether $10,948 will be paid as tax in the third year. For the fourth year, the inflationary cash flow will be 64,792. From that, we are going to deduct tax depreciation of 48,281. That will result as taxable profit, which is 16,511. For that 16,511, applying taxation of 30%, that will give you $4,953. But we are not going to pay entire $4,953 in the current year. We are going to pay half of that amount in the current year, which is 2,476 plus previous year's half, which means third year's half amount is there to pay, which is $6,181. Altogether, tax payable amount will be for the fourth year will be $8,657. Even though this project's lifetime is only 4 years, there will be a transaction of $2,476, a cash outflow for the 5th year. This derived from we have paid 30% taxations half in the 4th year, which means we have paid only $2,476, which is half of $4,953. Other half of that particular $4,953 will be paid in the 5th year. That transaction will be occurred in the 5th year. Fine guys, 2 more steps to go, which are step 5 and 6. Wait for the part 2. Stay tuned. Good luck guys. See you in the next video.